What is the significance of a strong dollar back 20 years?
Oh, well, this is, as you say, a pretty strong dollar, but I think what it's reflecting is the riskiness of other assets. I mean, there is a pretty strong correlation or inverted correlation between the dollar on one hand and risky assets. When risky assets are not performing well, the dollar goes up and vice versa. And I think if we look at the tone in markets right now, people talking about
Right.
a recession in the US, recession potentially over the winter in Europe because of gas prices, slower growth worldwide, then that's an environment which the dollar performs well and risky assets do not. And I think that's, very much a story that we're looking at right now.
I don't go short term with too much respect for your work, Jane, but I am going to do it here on June 30. Where does euro and yen set up against dollar September 30?
Well, our forecast for dollar yen, sorry, for euro dollar for a while has been, 103-ish. And the reason for that is that, we have this massive big support level in 103.5. And we're staring really closely at that today. If we go below that, we could see parity. And I think for a while
Right.
we've been able to outline the risk for parity. And this is to do with Europe. This is to do with gas prices high over the winter. This is to do with that creating these recessionary conditions, stagflation, and that, of course, putting a lot of focus on fragmentation in the Eurozone, which is a bad story for the euro. So that is what we're looking at, I think, this week. But with respect to the yen, well, that is I think, a yield story. Now, the dollar's gone up today more than the yen, and it's brought us up to above 136. But actually, if US yields do start to come down, then I think that gives the Bank of Japan a little bit of room to, carry on doing their yield curve control until they want to stop it, which will be when wages begin to go up in Japan.
Jane, I want to stick on the euro for a minute. You're really saying it's quite bearish for the euro right now, which a lot of people see the same, especially given some of the gas constraints for Germany. So why haven't we seen more weakness already?
You know what? I think people are only just beginning to come around to the recessionary story for the Eurozone. We've had that as a forecast for a while, and we've been an outlier. But I think more recently, that has become, or that view that we could see recession over the winter months has become a little bit more commonplace in the market. Now, we've got Lagarde still defending the view that she still thinks the ECB, we would still carry on seeing growth in the Eurozone. But the fact that she's defending it again this week, the fact that she's reiterating it, almost sounds like a pushback against the fact that she's aware of these weight of views coming through from the market about Eurozone growth. Now, if you look back to last week, we had the German finance or economy minister talking about the possibility,
Yeah.
that we could have maybe supply cut off to some industries in Germany. That would relate to Italy too. Very difficult not to see recession if that happens.
Jane, the spiraling effect of a weakening currency in an inflationary environment is something that is also a bear case because it will only exacerbate inflationary pressures in the euro region, prompting the ECB potentially to act more aggressively, only furthering the downturn. How much are you looking at the incremental weakening in the currency as a bear case for the economic trajectory?
This is really quite interesting, and I think we've seen this quite a lot in the last few weeks, certainly this month, amongst central banks. If you look, for instance, at a speech by Catherine Mann from the Bank of England last week, she was talking about the spillover effects of the Fed hiking by large amounts, and that coming through into the UK, and perhaps setting the scene for a more aggressive pace of interest rate hikes in the UK, just to defend the currency. Now, you can see that already in Norway. Norway hiked interest rates recently by 50 basis points, bigger than expected. It only served to stop the currency going down. It didn't push the currency higher. The Riksbank today, 50 basis points, not an awful a lot of gain for the currency, etc. So we're seeing this momentum where central banks have to go big because all of the big ones are going big. And as you say, that can just accentuate the downside risks in terms of demand. And whilst that might fit well perhaps for the US, maybe for the Europe and certainly not for the UK, will that be necessarily suitable when you have less wage inflation and perhaps more vulnerable demand there?